Welcome to Learn Geo, where we dive deep into the latest news and advancements in global affairs, international relations, and technology. Today, we are exploring the U.S. fiscal situation and its potential global impact, raising a myriad of concerns. These concerns revolve around credit downgrades, the rise in U.S. Treasury yields, and the potential influence on the status of the U.S. dollar as the global reserve currency. On August 8, Moody's, a prominent credit rating agency, made headlines by downgrading the credit ratings of several mid-sized U.S. banks. This move closely followed Fitch Ratings' downgrade of the U.S. credit rating. The effects weren't confined to just insurance companies and banks. Concerns about potential downgrades for municipal bonds also surfaced. As a result, the yield on the 10-year U.S. Treasury surged to 4.02%, marking a 6-month high since the beginning of August. This notable increase of 240 basis points is due to persistent investor selling. The turmoil in the U.S. fiscal landscape is catching Wall Street's attention, particularly how the growing instability directly impacts the valuation of trillions of U.S. Treasury bonds. Hedge fund manager Bill Ackman disclosed on August 8 that he's shorting 30-year U.S. Treasury bonds based on supply and demand dynamics. Meanwhile, Ray Dalio, the founder of Bridgewater Associates, warns that the substantial U.S. federal debt could lead to a debt spiral, potentially causing losses for U.S. Treasury holders. Financial experts predict that a U.S. credit rating downgrade could have far-reaching consequences, possibly challenging the dominance of the U.S. dollar and the credibility of U.S. Treasury bonds. This situation might accelerate the global shift away from the dollar, paving the way for a multipolar financial landscape. Notably, gold could emerge as a more reliable store of value compared to U.S. bonds, evidenced by the ongoing increase in gold purchases by global central banks, including China. This shift could exacerbate the pressure on the U.S. Treasury's ability to manage its growing deficit. On August 5, the U.S. Treasury adjusted its outlook for federal borrowing this quarter. This strategic move aims to address the deteriorating fiscal deficit by replenishing cash reserves, given the persistent sluggish revenue and accelerated spending. The anticipated net borrowing for the August to September period was revised upward to a staggering $1 trillion. Projections even suggest that the U.S. national debt might surpass $50 trillion by 2030. Exceeding even the most pessimistic estimates. The mounting federal deficit raises concerns about the U.S.'s fiscal management and its ability to meet its debt obligations. The recent closure of a regional bank across 3 states adds urgency to this concern, marking the 5th bankruptcy since March and underscoring the ongoing U.S. banking crisis. This situation could potentially become the tipping point that endangers what some term the world's largest Ponzi scheme built upon U.S. bonds. The U.S.'s lavish lifestyle, supported by currency printing, hinges on the dollar's status as the global reserve currency. However, the Federal Reserve's fluctuating monetary policies and doubts about the dollar's security have shaken confidence within the U.S. financial system. Investors are increasingly questioning whether U.S. bonds can continue to be the cornerstone of the global financial framework. Deutsche Bank's Global Economic Risks Report, released on August 9, highlights the substantial risk a U.S. credit rating downgrade poses to market stability this year. This raises concerns about the U.S. economy's ability to sustain its trillions in deficit. Shifts in U.S. Treasury bond holdings, coupled with yield curve inversion and divestment trends, intensify these concerns. An analysis by Zero Hedge published on August 9 suggests that an intensifying U.S. economic recession threat and escalating systemic risks from the U.S. banking sector could undermine the U.S. Treasury's capacity to uphold what some call the world's largest Ponzi scheme. This scenario could hasten the liquidation of U.S. Treasury bonds by global central banks like Japan, China, and France. Amidst mounting uncertainty, the potential of complete divestment from U.S. bonds becomes more realistic. Timing Securities emphasizes the strategic significance of Japan's and China's substantial sales of U.S. Treasury bonds, setting off sell-offs and raising concerns within the U.S. Treasury Department. An August 2 report from the securities firm highlights that the accelerated de-dollarization process prompts central banks to repatriate gold assets from the United States, strengthening asset security. Approximately 70% of central banks express concerns about potential U.S. limitations on their assets, a noteworthy increase from 3 years ago. China's holdings of U.S. Treasury bonds have consistently diminished over the past decade, dropping by 35% compared to the peak value in 2013. Notably, China divested $470 billion worth of U.S. Treasury bonds in the previous year. The rapid pace of U.S. Treasury bond liquidation contrasts with China's consistent increase in gold reserves. These unfolding developments could further erode the U.S. dollar's vulnerability to export inflation and seigniorage, potentially contributing to the gradual erosion of the dollar's global reserve currency status. This sentiment aligns with the U.S.'s repeated raising of the debt ceiling. The World Gold Council highlights the challenges central banks face with U.S. Treasury bonds, offering minimal or negative real yields over the past decade. Challenges involving U.S. bond credit, banking crises, and past Eurozone debt crises indicate that these nations still confront substantial default risks. However, the U.S.'s use of the dollar as a tool to exert control over other nations' financial systems casts doubt on the security of U.S. bonds. Amidst the looming threat of a U.S. credit rating downgrade, ongoing fiscal deterioration, and persistent sell-offs of U.S. Treasury bonds, concerns of a currency war persist. On August 8, U.S. Treasury Secretary Janet Yellen expressed strong disagreement with Fitch's decision to downgrade the U.S. credit rating, considering it outdated and arbitrary. She stressed that despite alternative initiatives, U.S. Treasury bonds remain a secure and liquid global asset. In recent months, countries globally have been actively pursuing de-dollarization and aiming to reduce reliance on the U.S. financial system. At this pivotal juncture, marked by a potential U.S. credit rating downgrade and international efforts to identify dollar substitutes, the unexpected proposition of returning to the gold standard has taken Wall Street by surprise. During an August 1 media interview, Jim Rogers, a prominent financial figure, underscored the United States' status as the world's largest debtor nation, grappling with pervasive money printing and debt accumulation. Rogers revealed that the actual U.S. debt is nearly 7 times higher than the publicly disclosed figure, approaching $160 trillion. Given the severity of the escalating debt, Rogers believes that an impending and profound U.S. economic recession is inevitable. Even returning to the gold standard, he argues, won't effortlessly navigate the complexities of the current economic landscape and the looming specter of debt defaults. As the intricate economic landscape unfolds, thank you for tuning in, and stay tuned for more enlightening content coming soon.